What if I told you that right now, we're living inside the biggest financial bubble in human history? Not just stocks, not just crypto, not just real estate, but everything, all at once. And what makes this terrifying is that it's powered by something no previous generation has ever dealt with. I'm about to break down why this bubble is fundamentally different from 1929, 2000, or 2008, and why the crash, when it comes, could reshape civilization itself. But first, if you want to stay ahead of the financial chaos coming our way, smash that subscribe button and hit the notification bell. Trust me, you'll want to see what's coming next. Let's start with the obvious question. What exactly is the everything bubble? Picture this. Every major asset class is simultaneously at or near historic highs. We're talking about stock markets trading at 30 times earnings, when the historical average is 15 times. Real estate up 400% in some markets since 2010. Cryptocurrency with a combined market cap larger than most countries' entire economies. Government bonds with negative real yields for the first time in modern history. Art, collectibles, and even Pokemon cards reaching astronomical prices. This everything bubble stands on three pillars that didn't exist in previous crashes. Remove any one of these, and the entire structure collapses. Since 2008, central banks have printed over $25 trillion out of thin air. That's not a typo. Trillion, with a T. They've essentially turned the money supply into a video game cheat code. But unlike previous money printing, this time, it's coordinated globally. The Fed, ECB, Bank of Japan, Bank of England, they're all printing simultaneously. Here's the scary part. Over 80% of all trading is now done by algorithms, not humans. These AI systems can execute millions of trades per second, and they're all programmed with similar logic. Buy the dip. Stocks only go up. Infinite QE equals infinite gains. It's created a feedback loop where machines are trading with other machines based on the assumption that central banks will always save the market. And then, there's the human element. But it's unlike any previous generation. We have 18-year-olds on TikTok teaching investment strategies, Reddit communities moving billion-dollar stocks, and influencers promoting crypto projects that didn't exist 6 months ago. Information spreads instantly. Emotions amplify through echo chambers, and FOMO has become a legitimate investment strategy. Now, every generation thinks their crisis is unique. But let me show you why this actually is different using hard data. The 2000 dot-com bubble was worth about $5 trillion at its peak. The 2008 housing bubble was roughly $8 trillion. Today's everything bubble? We're looking at over $50 trillion in inflated asset values. It's not just bigger, it's bigger by an order of magnitude. Historical bubbles took years or decades to form. This one went parabolic in just 24 months, from March 2020 to March 2022. High-frequency trading and social media acceleration have compressed bubble cycles from decades into months. But here's the kicker. Everything is connected now. When Evergrande, a Chinese real estate company, showed signs of trouble, it immediately affected crypto prices, commodity futures, and tech stocks globally. One domino can topple everything because it's all one giant, interconnected system. What makes this bubble truly terrifying isn't just its size. It's the multiple black swan events that could trigger its collapse. And unlike previous bubbles, we're facing several simultaneously. We have active conflicts affecting global supply chains, potential Taiwan invasion scenarios that would devastate semiconductor production, and currency wars as countries try to decouple from the dollar system. Climate change isn't just an environmental issue. It's becoming a financial stability issue. One major hurricane hitting Miami, a drought affecting California's agriculture, or flooding in financial districts could trigger cascading economic effects that algorithms aren't programmed to handle. And here's what keeps financial experts awake at night. Our entire system now runs on technology that didn't exist during previous crashes. One major cyber attack on the financial grid, an AI system malfunction, or even just a widespread internet outage could freeze global markets instantly. So, what happens when this bubble finally pops? Based on historical patterns and current vulnerabilities, here's what a crash might look like in real time. It starts with a single trigger. Maybe a major bank announces unexpected losses, or a key algorithm malfunctions, or geopolitical tensions spike suddenly. Within hours, high-frequency trading algorithms detect the anomaly and begin selling. Social media amplifies the panic. Retail investors who've never experienced a real crash panic sell everything. Day 2. What started in stocks spreads to crypto, then real estate, then commodities. Because everything is interconnected and over-leveraged, losses in one area force selling in others. Margin calls trigger more selling. The diamond hands meme crowd discovers that diamond hands still feel pain. Week 2. Credit markets freeze. Banks stop lending to each other. Companies can't roll over debt. The real economy, jobs, production, consumption starts feeling the impact. Central banks try their usual tricks but discover that infinite money printing has limits when people lose faith in the currency itself. Now you might be thinking, I don't own stocks or crypto. Why should I care? Here's why this affects everyone, regardless of your financial situation. When asset bubbles pop, they take jobs with them. The 2008 crash eliminated 8.8 million jobs. Given the scale of the everything bubble, we could see unemployment rates not seen since the Great Depression. As central banks respond to the crash with even more money printing, the purchasing power of your savings erodes. Your rent, groceries, and gas all become more expensive, even if your income stays the same. And here's what historians know but economists often ignore. Financial crashes don't just hurt portfolios, they topple governments and reshape societies. The last time we had wealth inequality at current levels was 1929. We all know what followed. But here's the good news. If you understand what's coming, you can prepare. And preparation doesn't mean becoming a doomsday prepper or hiding cash under your mattress. Build genuine financial resilience. Emergency funds in multiple currencies, investments in real assets, like commodities or foreign real estate, skills that remain valuable regardless of economic conditions. Avoid leverage like it's poison, because in a crash, leverage kills. Develop skills that artificial intelligence can't replicate and economic crashes can't eliminate. Critical thinking, emotional intelligence, practical problem solving, and adaptability. These become incredibly valuable when systems break down. And perhaps most importantly, build real relationships and local networks. When global systems fail, local communities become crucial. The people who survive and thrive through crashes aren't necessarily the richest. They're the most connected and adaptable. What do you think? Are we really in an everything bubble? Or is this just normal market evolution? Have you started preparing, and if so, how? Drop your thoughts in the comments below. I read every single one and often respond personally. And if this analysis helped you understand the bigger picture, consider subscribing and sharing this video. In times like these, informed communities make better decisions than isolated individuals. Hit that notification bell so you don't miss our next deep dive into the economic forces shaping our future. Next week, we're diving into something even more mind-bending. How artificial intelligence is quietly reshaping global power structures in ways most people don't even realize. You won't want to miss it. Until then, stay curious, stay prepared, and remember, in times of change, knowledge isn't just power, it's survival.